Okay, we're live. Well, welcome to the channel, everybody. I'm the host, Greg, for DLA Markets, and we are continuing sort of a series of interviews trying to focus in on the economy and what's going on out there as it relates to the markets. And this week, we're focusing on the commercial real estate sector. Okay. And as our guest today, we have a very experienced real estate investor, Greg Jones of GRJ. And he is a New York City based real estate investor. He owns real estate in New York City and elsewhere, primarily in the Southeast. And we've known each other for many years, and we've actually done business together. I think we've done something like $100 million of business together in the last year or so. So without further ado, let me introduce to you Greg Jones. Hey, Greg, you there?
I'm here, Greg. Thank you.
Yeah.
Thank you for having
All
me
right.
on.
All right. Cool. Well, you have tons of experience in the market, and I thought it'd be very interesting for the subscribers to hear your view in real time. So maybe as a first step, why don't you just sort of introduce yourself, your company, and what you're currently involved with.
Absolutely. And thanks for having me on. I'm a fan of the podcast, been following. I think you got a lot of great nuggets on here. So thanks for having me on. Hopefully I can add to it.
Thanks, Greg.
So we started off, my brother and I, Graham, started the business really in 2010, kind of at the tail end of the financial crisis in New York. And bought our first apartment building in New York 2001. 2011, not 2001. We're really focused on a New York strategy when we first started. At one point, we had close to 1,000 apartments in New York. Maybe it was around upper 800s. And we sold a number of them from the late 2015, 2016 area. New York started to get very expensive for us. There were some regulatory concerns that we had. So we started branching outside of New York and purchasing assets throughout the country. So we've done a number of deals in the Southeast, Florida, Tennessee, Mississippi. We also have our own hotel destination brand right now. We have hotels and destination locations in Newport, Rhode Island, and Daytona Beach, Florida. We're a vertically integrated firm. We do all leasing, construction, property management in-house. And we've been in business for the past 13 years now and been working with you on a number of deals and really bootstrap this from the ground up to get where we are. So it's exciting to come into work each day and go after things.
Hey, that's great. So, look, with the Fed raising interest rates at an unprecedented level, stopping QE and going to QT, and all the things that have been happening in the economy, it's clearly affected commercial real estate, as we all know. What's your perspective, from an owner-operator's perspective? What's your perspective on what's going on in the economy right now, and also maybe touch on Fed policy and interest rates?
Yeah, so I'll tell all your listeners this. If it's one thing to take away from this podcast, real estate has a beta of 1 to interest rates, which means that as rates go up and as rates go down, so do real estate values. You want to know what makes real estate is how much non-recourse debt you can get on it. And I think Buffett actually mentioned that once. That's really what values and what the valuation is of your real estate. And as rates go up, debt gets more expensive. So properties are sold on what's called a cap rate. And the cap rate is essentially it's somebody's yield on the property when they're purchasing of your existing NOI, which is your net operating income, or essentially your net income for those of you guys who look at business financial statements. The lower the cap rate, the better for the seller. The higher the cap rate, the better for the purchaser. If you sell something at a lower cap rate, you essentially get a higher value on your NOI. What drove cap rates, and there's other factors, but the predominant factor is where rates are. So what can I borrow money at? So in really the past 10 years, we've had just incredibly easy money, qualitative easing, QE going on forever, really, since we started our career, where rates were at, 2%. In some instances, you were able to borrow non-recourse debt at something at, 3% or less, where spreads were. And some people were fortunate enough to lock in long-term money on that. So if I can borrow at 3, I can purchase at 4, and I'll have what's called positive leverage. Positive leverage means your cap rate is higher than what you're borrowing at. Now, when rates are, even with the agencies, which are the least expensive game in town right now, um, in the high fives and sixes right now. So you can't realistically, outside of some special circumstances, sell a property or purchase a property for a 4 cap because you have such negative leverage on that. Your borrowing costs are so much higher. So as the Fed has raised rates, what they've done is increase the borrowing costs for purchasers of real estate. And you're in a very difficult situation right now where the Fed has raised close to, between 600 basis points in 18 months. And you can't do something like that and not break something. And I look at the Fed as it's like a pendulum, right? They swung way too easy for too long, and now they're just swinging way back the other way. And you have a lot of maturing debt that's coming due. Let's just forget about values, right? I mean, the values that people are getting, even in the COVID era when, rates were so low, or before that in the 2015s or 17, 18, it's just not feasible to purchase properties at those. So I'd say across the board, properties are down 20% or more from peak valuations. The problem now is that you have a lot of maturing debt coming. And that means that people who borrowed at 3 and 4 have to refinance now. And that refinance market is 6% or higher, which is a huge, huge, huge expense for when you take interest rates on $40 million of debt up 200 basis points, and you're finding situations where people just can't get out of their loans because the coverage on that loan doesn't support the current loan. So people have to come up with money to get out of their loan, which is coming due. So that creates a lot of problems. And I think most people in my position are hoping, there's kind of a term in our industry, survive to 25, that if you can get through this, when rates come down, you'll be okay. But there's a lot of maturing debt and nobody's getting through it without working with their current lenders. And it's not clear to me that many lenders, I think it's still waiting to be seen, and some of it depends on the asset class, what lenders are going to do in terms of extending maturities or working with people, with their borrowers. But, people, Barry Sternlicht is one who was pretty pressed, and real estate, it really is in a category 5 hurricane right now. It's in the middle of it. And it's what's going to happen. Is the hurricane passing, or is it going to sweep everybody up? And we're going to see with all these maturities that are coming due in the next 18 months, what's going to happen. And on the other side of the coin, there should be opportunities, which is what I'm very interested in finding opportunities from those people, from those operators who maybe were a little too aggressive, who over-levered the property, who put in, crazy assumptions on rent growth and NOI growth, and they were planning on getting out of the real estate in 2 years, which goes back to what we originally talked about. Forget borrowing costs now. The real estate is just worth less because they can't sell at those cap rates. So it's kind of a perfect storm that the Fed has created this, by the way, right? They were the ones who had the low interest rates forever, and now they've created the problem. It's not like real estate essentially did anything wrong. We were just playing within the rules of the game. And now we are affected more than anyone with what the Fed policy is. And I will say that, that pendulum can really swing the other way. And you saw what happened with SVB and First Republic when rates were actually at this point. And I think if they stay up here, you're going to see a lot of other reverberations in the economy.
Right. That's great input. We've made the point many times on this channel that we believe that interest rates are going to stay higher for longer than most people think, and one of the main reasons for that is all the fiscal spending on the fiscal side, the $5 trillion that was flushed into the system by the Biden administration, when, according to Stanley Druckenmiller, it wasn't needed because the economy was already recovering from COVID. So I think, and correct me if I'm wrong, but I get the impression that there's a lot of properties out there that might have great occupancy levels, and if they have long-term debt locked in, they don't really have a problem because they're still covering their debt service, they're still paying their investors, etc. That, of course, could change if the economy weakens and people start losing their jobs. But the real problem comes in, as you referred to a moment ago, when the debt comes due, then you have a valuation problem. Um, do you see that happening a lot in New York?
Well, New York's a different story. I mean, the thing about New York is the political ramifications here are just so far different than anywhere else in the country. It's an extremely hostile place to do business. The 2019 rent law, we could have a podcast just on that alone, what it did to property values. I mean, I have 17 vacant apartments across our portfolio that are essentially illegal for us they are illegal for us to renovate and rent. These are apartments that paid $600. The tenant passed away or left. It will cost us $150,000 to renovate it, and we can raise it $84, and they take it back. So who would ever make that investment? So if you want to know why rents are so expensive in New York, for any of you who live here, it's supply and demand. There's no supply. You can't create a free market apartment in New York, and the demand is still there. So until they fix that, it talks about the fallacies of rent control. Um, that's one other nugget I'll give you in real estate. In addition to interest rates, it's all real estate is all supply and demand. What's the supply of product? What's the supply of housing? What's the demand? And then you can back into things. It's a simple tenement. You can go to business school. You could do NPVs, everything else. All that's important, but at the end of the day, it's just simply supply and demand. But going back to your question about the assumptions and the valuations, it's interesting. I would say that 90, and I'm not being dishonest, 90% of the deals that I see now are loan assumptions, because
Right.
it's the only way that people think that they can sell. They can say, "Oh, I've got this," and there were people who put long-term debt at 3 and 4%, and selling something free and clear right now is very challenging because of what we discussed previously. Because someone says, "I got to borrow at 6.7%, I can't pay you a 4 cap or a 5 cap. I'm underwater day one."
Right.
So you're seeing loan assumptions. And that is what people are. But the problem with the loan assumptions is, and I tell people this because I just bid on one, is, that's great that this is the assumption, but this property is not even worth the loan. That's what it's worth. So it's
Right.
almost being propped up that, oh, it's interest only at 3.85%, but it almost doesn't matter. I mean, it matters in some instances, and you can make it work. And those are the deals that are getting done, are the assumptions. Because the borrowing costs are so heavy right now to purchase something. And the Fed knows that, and they're doing that on purpose because they're trying to drive down asset values. The thing that the Fed is doing wrong, like, again, go back to supply and demand. Some of you who are looking to buy a home who are listening to this, I mean, look at where rates are. You're at 7% right now. So nobody can afford to buy a home. So what are they doing? They're renting. So now rental prices are continuing to go up because home ownership is almost unobtainable for people, because nobody wants to build more homes. Because if you build more homes, you have NIMBYs, you have zoning restrictions. That's really what we need to do. Is we need to increase demand. We need to build more homes for more people, affordable homes. What the Fed is doing now, and I don't think they've even realized, is by drawing up borrowing costs at 7%, they've created this dichotomy, right? So say that you own a home that you purchased in 2020 and you're locked in at 3% right now. Why would you ever sell your house?
Right.
You can't replicate that rate. So what you have is you have a shadow inventory of homes that are essentially off the market, that they're just not going to be listed. So we go back to supply and demand. So the supply is so low because of Fed policy, because of what they've done in raising rates this high. So the demand is still there. People want to have homes. They're starting a family. They want to, have that slice of the American dream, and they're bidding up the prices of whatever is available despite where rates are. So there's a lot of repercussions, unintended, I think, of what the Fed is doing. Again, I'll go back to a pendulum. I think that they were too easy. Now they're too hard, and they got to figure out a way to kind of land in the middle, or I think there's going to be a lot of problems. And I think you'll see that shortly, depending on how much higher for longer. I agree that no, we're not going back to 2%. But I think if they stay up here for longer, I think there will be some problems.
Interesting. One of the things I wanted to touch upon, because I know you've done a lot of borrowing from the banks, you have a lot of banking relationships, and from my perspective, the banks, particularly the regional banks, were very aggressive on the way up. And from where I sit, I would see deals getting done by banks that I thought was a ridiculous amount of risk for a commercial bank to be taking. And the quid pro quo that was going on there was, okay, you give us a bunch of deposits and we'll extend you this credit. I think that from a policy standpoint, that's something that should probably be illegal. That quid pro quo, so to speak. But now, and I'm sure you're aware of this, the Fed just came out with additional banking regulations and additional capital requirements that are intended to, or as a reaction, to SVB and Signature and the recent bank failures. I see that as further restricting credit. How do you view that as a real estate investor?
So I certainly agree that regional banks have been a huge portion of um, the real estate lending and asset class of where we've gone over the last 10 years. Um, and I think that they've been an important partner for us and for other operators. What's happened now and is that the regional banks have been forced with where rates are right now is that we talked about deposits. So they're actually having an issue now where they're seeing a flight of deposits, which you heard with SVB and First Republic, where people are saying, I can get 5.5% in the money market right now, or I can get, 3-month treasuries at 5%. Why am I keeping it at my bank that's earning me 50 basis points on my money? Which is what it was when they were lending this money, because they didn't have to pay out much in deposits. Rate were so low, and they could borrow money. They could borrow money to operators cheaply. Where rates are now and the alternatives, that deposit money is fleeing. So now what banks are forced to do is they're forced to up the deposit rates on their CDs, on their money markets to keep the deposits there. And deposits are the lifeblood of banks. They need that deposit money to lend to real estate operators like myself. So in order to do that, they now have to raise their borrowing costs. And I absolutely agree. Every deal I've ever done with the regional bank, part of the deal has been the deposits. So they keep the deposits, they keep the operating account, the security deposits. They want those deposits. That's how they grow. And that's
Yeah.
what they've done. Um, Now they're in a situation where the deposits are fleeing and they've got to raise their costs to keep them. So they're
Right.
lending you at more expensive.
Right.
So what I would tell you right now, for anyone who's listening, if you're looking to do a loan with the regional bank, I'm not seeing any loans getting done that aren't existing relationships. And
Mhm.
our biggest regional bank partner has said that. They said, we're not doing any deals unless it's existing relationships, where there's a deposit relationship and we know who the borrower is and they've performed with us. It's just they're not doing it. There's banks are just as concerned as we are about the economy and rates and what's happening, and they just don't want to take that when previously they'd be fighting over each other to lend on stuff.
Right.
So honestly, the cheapest, if you're just looking at, and it depends on the sector that you're doing, industrial office is different. Office financing is almost completely dried up or very expensive. I mean, you were looking at double digits. But on the pure multifamily residential, the cheapest game in town is still the agencies. When I say the agency, I say Fannie, Freddie. Their spreads are a lot lower. When I say spreads, I mean what they essentially lend over a benchmark treasury. They'll under
Mhm.
200. I mean, they'll be around, some of them will be around 185, where
Right.
regional banks right now might be at 275.
Right.
And you have other alternative lenders who are even higher than that. So regional banks were a huge partner for real estate operators, and it has absolutely changed now with where
Yeah.
rates are. And unless you have an existing relationship, it's going to be very hard to get loans from a regional bank right now.
Yeah, and I think the point that Jamie Dimon made a week or so ago is that I think his position was number one. What happened with SVB and Signature and First Republic, what was not necessarily due to the fact that we didn't have enough regulation. It was due to the fact that the regulators basically failed to regulate, and also that the managements of these banks were completely inept, going, buying long dated securities at two
Yeah,
percent interest rates and
30-year
not
treasury.
right, and not hedging them. I mean, that's like what a third grader could figure out that that's a dumb idea. So, and the other point he was making as a result of that, more regulation comes in that further restricts credit, and that's going to hurt not only real estate investors, but it's going to hurt the economy. Um, so I guess that's what we have to look forward to. But I guess it puts insurance companies, alternative lenders, insurance companies, the agencies, private, other types of private investors. It gives them an advantage now because banks are going to be, if not out of the picture, they're going to be greatly reduced
Greatly
as a
reduced.
factor. Yeah.
Yeah, very hard. It's
Yeah.
got to be a relationship for, I think, to get a regional bank. It'd be very hard to start right now with a and get something going with a regional lender. It's just they're just not lending like they used to.
Right. Um, there's two more questions I have. One is, as I look at commercial real estate, and I've been an investor as well as a lender. Um, One of the things that I think has changed from 20 to 25 years ago is that 20 to 25 years ago, real estate was a great asset class to get into. It was a way that many people became wealthy, both through owning a house as an individual or as a commercial real estate investor. One of the things that really strikes me recently, and New York is a prime example, but is that commercial real estate has a lot more political risk than it did 25 years ago. Could you speak to that a little bit?
Yeah, I mean, I think that's why you're seeing the flight of capital and interest to red states. I mean, the most crowded trade in the country is multifamily in red states. I mean, everyone's
Right.
going to Florida, the Carolinas, and it's just because it's seen as, free market capitalism. You want to improve an apartment, you want to spend money, get the rent that you want, go ahead. That's what, the system was based on. Where in blue states, the political risk is something you can't quantify. I mean, I mentioned the
Yeah.
2019 rent law in New York, which nobody thought was possible. I mean, it's if you look that law up, I don't know how you could classify it other than a taking of private property. But
Hmm.
it passed the legislature, it passed the Senate, and was signed by then Governor Cuomo. And New York has is one party rule, Democrats and socialists, I guess two or one and the same, and um, that's what they passed. So when you're seeing why the values and the capital is fleeing to red states, is because people perceive the political risk is much less. I mean, I'll tell you something which might shock people now. I mean, there are certain product in New York, even in Manhattan, in New York City, that is cheaper than buying in areas of Mississippi right now because people just don't want to touch it. They don't know what to do with it. You look at a 100% rent stabilized building in Upper Manhattan. What are you going to do with it? The city dictates your rent increases, your property taxes go up 20% year over year. It doesn't matter. Your insurance costs. So what I've found, and what I've looked at when I assess real estate is you have not just operators but lenders who don't want to be on that political risk. You have insurance companies, which you might read about, who don't want to be on the risk these, in these areas. So political change is difficult to come by. Political change is difficult to quantify, but there's real political risk in a lot of these locations. And I'm sure you've heard, you're in the business, people just say, we're not lending in New York City, or we're
Right.
not doing deals in New York. And that's
Right.
interesting because then you want to think about the contrarian view that, things almost have to change, which is what I'm coming around to because, things change when the money runs out, and the money's running out up here. I can tell you that.
Hmm.
Real estate
Hmm.
was certainly, if you talk about New York, was the lifeblood of New York City. I mean, that's where they got all their taxes, their revenues,
Right.
supported all the social services that made New York such a great place to live. And when you dry that up and essentially make it an unfathomable path towards creating any type of return on your investment, you don't get transfer taxes, you don't get mortgage recording taxes, values go down. So it hurts the
Yeah.
city more. So it's kind of short sighted. But you have to think about political risk wherever you purchase. It has to be there. And right now it's on the forefront of everyone's mind, particularly about what happened in states like uh, blue states or blue cities, where that's really, we have various forms of rent control or laws that have really, really hurt values. Um,
Hmm.
so people have to think about about that when they're investing or where they're investing.
Yeah. Yeah. Interesting. So I guess for the last question, I don't want to make this too long, but the last question is, where do you see the opportunities? I mean, as we go into this uh, economic situation where I guess the consensus, at least in the stock market, is soft landing. Um, and if you look at historically over the past 500 years, as I've said on the channel in the past, um, this kind of an asset bubble and this kind of an interest rate scenario and liquidity scenario has always resulted in a severe recession. We may escape that with all the fiscal spending, But it's a difficult question, really, as you look forward, because you don't know what the government's going to do. I mean, where do you see the opportunities as an investor?
So it's interesting. I do, and I speak with my brother about this. I equate this time to really when we started, which is coming out of the financial crisis, where things were uncertain. There were banks weren't lending. It was difficult to get investors, and you have all of that present now. Now it's not entirely the same thing. There's a lot of different factors, but I still think that there is opportunity right now in pursuing properties where people were off sides in that um, they can't get out of their loan. They put short-term capital on this. I mean, you're seeing properties trade that discounts that weren't you know even comprehensible years ago. Now there hasn't been the cascade of that. It's not like the savings and loan crisis or anything like that where people are puking real estate, but there are select opportunities out there that were not available in the past 10 years. And for anyone who's listening to this, I would tell them now is the time to think about getting on the principal side, finding some investors, looking for opportunities, because I believe in the country. I believe in the economy. I do think we're headed for some more difficult times, but I think we're going to come out of those like we always have. And there's an opportunity now to be purchasing. I mean, I'm more aggressively trying to buy things now than I have been in the past 5 years because, first of all, the amount
Interesting.
of people buying is that it's completely dried up. People are just those people who got caught off sides. They're investors. They're in a lot of trouble. They're not buying more. They're just trying to hold on to their properties. Their capital is getting put into capital calls to maintain their stuff. Those people who prudently navigated the last cycle and have dry powder should be buying now. They really should, because if nothing else, you're going to see, a slight downtick of rates or the Fed cutting or saying that. I mean, at some point they're going to cut. I think one of the governors mentioned that yesterday. What that's going to do for
Mm,
values is going to be exponential. So
mm,
I'm seeing opportunities in real estate right now. I'm not seeing as many opportunities I would like. I don't love the office conversion. I know that a lot of people are talking about that because I think
yeah.
that's too binary in that you really have got to get, going back to political risk, you have got to be doing that in an MSA where you have a friendly zoning or local government to allow that conversion to make sense. In New York, it's
Hmm.
very challenging what they would want to even allow that. And some of those buildings are so outdated that the
Yeah.
amount of capital you'd have to put into them to make it feasible is almost too much. But there is opportunity in, first of all, just pure on evaluations. Even properties that are not in any trouble right now, they're
Right.
trading at discounts for where they were 2 to 3 years ago. And if you invest in places where you see the demographics growing, you go back to that whole supply and demand that I talked about, where you see rents rising and you can get in at what was a good basis
Yeah.
and you're a little more patient, now is the time to do it. It's harder if you don't have an existing lending relationship, but there's not as many people buying right now. And I think those that buy right now and buy intelligently and do stuff that's a little hurts a little bit because rates are there, and I think that they're going to be rewarded and they're going to look pretty smart in a couple of years. So that's what we're looking to do.
Okay, great. Well, Greg, I think that's probably a good place to wrap it up. I want to thank you, profusely for agreeing to do this. Your thoughts on the issues were very interesting, and I know everybody's going to enjoy it. So, thank you very much for joining, and I appreciate it. And we'll be having you on again if you're willing to come on to continue to talk about this.
Yeah, I'd love to. I'd love to. Thanks, Greg. I really appreciate it. Thanks for having me on.
Okay, thanks.
All
Take
right, talk
care.
soon.